Hi guys, I'm Dan, this is Kai, we are the directors at Crescent Mortgages, and today's FAMQ, frequently asked mortgage question, will be delving into the difference between fixed versus variable rates. Now, we have filmed this particular topic before, but today it will be a bit more applicable to the current market, the current UK mortgage market. We're filming now December 2022, coming into the 2023 market. So things have changed quite significantly in the UK market in the last 6 months. So let's jump into it. We'll start with the basic and maybe obvious to some people differences. Fixed versus variable. So just to skirt over the edges a little bit. What's a fixed rate?
So a fixed rate it's an interest rate that will remain fixed. It will stay the same throughout the 2, 3, 5 years of a product that you've picked.
The agreement, I guess, with a fix is that you are committed, you're normally tied in on a fixed deal. So if you go for a 5-year fix, you're normally tied in. So you're committed to staying with that lender for the 5 years, and they are committed to giving you that specific interest rate for the 5 years, regardless of what happens to the market. That's a bit more straightforward. If we come to variables, so there's a few types of variables, aren't there? I guess you've got a tracker, which follows the Bank of England base rate, a discount variable, which is generally the lender's standard variable rate minus a specific percentage, or just the lender's SVR, so they're their standard variable rate. They're kind of the three main ones that you're likely to come across, aren't they?
Yeah.
If you go for a variable scheme, kind of it's in the name, you're not guaranteed that the interest rate will stay the same. So depending on the economy, if interest rates go up, your rate is likely to go up. If interest rates go down, obviously it will go down. And if interest rates stay the same, then in theory, you could be on a variable rate that actually remains unchanged if the market remains relatively stable. Most variables, similar to a fix, if you apply for a variable, will have an initial scheme. Often a 2-year, although sometimes they can be indefinite, but often you will have a specific period. At the end of that period, you would have to shop around and remortgage, just like you would at the end of your initial fixed deal.
Pros and cons, you get the ability to budget and stability. If you've taken a 5-year fixed rate, you know that your payments will be X amount for 5 years. So from a budgeting perspective, that makes things a lot easier. Quite simply.
Yeah, which is quite important for a lot of people.
Yeah.
That's probably the main pro of a fix, but more applicable to the current market, which again we wouldn't have covered in our previous videos. At kind of time of filming on the last couple of months, it looks like fixed rates have perhaps peaked, or they're perhaps kind of coming off the back of peaking, potentially as high as they're going to be for the foreseeable future. Some people are kind of panicking because rates are so high and they're fixing in for 5 years or sometimes longer. Just bear in mind that if you fix in when rates have peaked, it means that you are going to be committed to a very high rate for the next 5 years if you've gone for a 5-year fix, which if you're comfortable that the payment is affordable and all you're worried about is just knowing exactly what you're paying, then it might be the right thing for you. But just bear in mind that if interest rates, fixed rates start to drop across the next 18 months, you may have been able to shop around and found a lower rate if you'd have gone for a shorter scheme when you remortgage in, let's say, 2 years.
Yeah, and the con on top of that of say a longer term fixed rate, if you wanted to come out of that because rates have dropped in 12 months time, there's going to be a penalty charge almost all the time, and that penalty charge is quite high, certainly in the early years of the product.
It's not usually viable to just pay the early repayment charge to leave a fixed deal early. It's going to be very, very expensive normally. There are pros and cons of the fix, but again, at the moment, a long-term fix, we're not saying it's not right, but some people are opting for a shorter fix because they think that interest rates are going to be lower in 2 years' time when their remortgage would be due, and I think a lot of forecasts do kind of corroborate that. As far as variable rates, so pros and cons, now this gets a bit more complicated in the current market, but I guess just in terms of some of the basics. So pros of variable rates are that not all, but many do not tie you in. So if you go for a 2-year tracker that follows the Bank of England base rate, you can leave whenever you want. So if you move house within 2 years, you can leave and you're not going to have to pay any of those really substantial early repayment charges. Or if you want to shop around across the market because the market's changed, again, you can remortgage without taking the hit on a fee, which could be thousands of pounds. I think that was historically one of the most common reasons why people would go for tracker, because they didn't know that they could commit for several years.
Flexibility, yeah.
Flexibility.
Definitely. The other one is often and historically, and probably at the time of filming, they're cheaper. In periods of calm from 2009-ish up until probably 2022, not a lot happened with the base rate, and therefore it wasn't necessarily cheaper to go down that tracker route. But
it was a bit easier to, other than obviously referendum, potentially the pandemic. It was, I think, a bit easier to predict what was going to happen in the short term, wasn't it?
It was, yeah.
It wasn't as volatile as it maybe is at the moment.
No. So variables were taken, but rarely. But now they are cheaper in anticipation of rates potentially going up, which is another point slightly. But people can make a saving on those initially, and it's, I suppose, gambling on, do you think rates will go high enough?
Yeah.
If they don't go that high, maybe you're always going to pay less than a fixed rate.
I guess the reason it's kind of a little bit more confusing and it appears more contradictory at the moment is that a lot of the time people will go on a variable rate because they believe that rates are about to drop. So they believe that the base rate is going to drop. So you move on to the variable rate in anticipation that you think your interest rate is going to go down. And if some clients that are kind of financially savvy or they've done their research, they might go down that route. It's not quite as secure or stable, but it's a bit more of a gamble. But they believe that if rates are going to go down and the tracker or the variable goes down, then obviously your mortgage payments are going to reduce with it. It's a bit more complicated now because interest rates or variable rates in the Bank of England base rate is almost certainly going to continue to climb over the next however many months. So where it's sat right now, forecasts are kind of saying potentially it's going to continue to increase to 4.5% or so in some time, kind of the middle into 2023. It's almost certain, unless something crazy happens, that the base rate is going to continue to increase. So given that it's going to continue to increase, why would someone go on to a variable rate?
That sounds silly, doesn't it?
Really,
why would
really
you?
Does.
But at the moment, and possibly at the time of you watching this, depending on where you're at, they are much cheaper at the time. If at the time of filming or at the time of when you're looking, if a variable or a tracker is 2% lower than a fixed rate, then you've got a buffer there. Rates could go up 2% and you're still paying the same as a fixed rate. And at the moment, they're a bit like that. There is a buffer. There is a gap between what the best tracker and best fix is. And if you don't think the rate's going to go up high enough, then you may never go over that fixed rate.
Yeah. So right now, if you put yourself onto a tracker, your rate is going to be lower than if you put yourself onto a fix, and your payments are going to be lower than if you put yourself onto a fix. So really, then it comes down to how quickly do you think the base rate is going to increase? How high do you think it's going to go, and when do you think it's going to peak? Now, obviously, we don't know that for sure, do we? We don't know exactly what's going to happen, and that's where it starts to get tricky. If you do go onto a variable, you have to accept that you are taking a little bit of a risk. If you go onto a tracker now and the base rate continues to climb, and it climbs maybe quicker than people are expecting, into a higher point than what people are expecting, it will sooner or later overtake the fixed rates. And then at that point, you may decide to then remortgage over to a fixed rate, given that you probably won't be tied in. But obviously you don't know we don't know exactly what fixed rates will look like then. If fixed rates are very, very high then as well, you may have made the wrong decision, because you could be moving on to a fixed rate then that's higher than it would be now for the next couple of years. But there's a reasonable chance that fixed rates are going to continue to potentially drop down slightly as well, aren't they? Yeah,
they've been coming down, and they will come down, it looks like, a little bit more. But then again, as the base rate changes and it gets to a peak, and maybe the base rate comes down again a little bit more, the fixed rates will fluctuate as well. So at the moment, they're coming down a little bit. So there is an argument to say that maybe you fix anyway, or maybe you wait for a little bit, you fix quite soon. Maybe you do go on a tracker. It's so specific to your circumstances and what you're doing in the market almost on the day or the week that it's hard to really predict. But this is going to chop and change throughout 2023, probably 2024, and the next few years as we go through a bit of a slightly messy economy as it seems to be predicted, at least.
Yeah. So I think what you've probably ascertained is we can't tell you exactly what to do, but that at least gives you kind of the potential difference and the potential pros and cons of which way you might go. Again, there is a possibility that putting yourself onto a variable rate now, and then maybe when the base rate peaks, maybe in the middle of next year, if fixed rates are at a reasonable level, then moving over to a fixed rate. That's, I know what some people are that's the way that some people are approaching it, and actually, all being well, that could work out to be the best way to go. But it really does depend on what interest rates do over the next kind of 3 throughout 2023. So if you want to discuss your kind of circumstances in more detail, or maybe we can start to narrow down what might be right for you, then you can leave the question in the comments, give us a call, drop us a message, or just head over to the website, and we'll see you soon. Thanks a lot.